Okay, good morning. Today we are going to do Chapter 11, and 11 is a rather short chapter. You're watching the video on Chapter 11 on this weekend. So what we're doing today, I'm doing some basic calculations to show you how to do those. So I know you haven't seen the Chapter 11 video yet, but that's fine. So we're doing Chapter 11 today. Back to what's due here. Okay, so what's due this week, Saturday, attendance quiz 22 covers class Monday, and today, Chapter 10 homework. In my accounting lab, we did everything for the Chapter 10 homework Monday. And then Sunday, the video quiz 23, it covers Chapters 11 and 12 in the Blackboard videos. Monday next week we will be covering Chapter 12. Again, it's a shortened chapter, so we will have plenty of time to do that. And next week, because it is Thanksgiving, we do not have class on Wednesday. Classes after 12 are canceled on Wednesday, and we're not going to have this class and not have the 2 class. So you guys get off because I have a 2:15 class. So both classes have off Wednesday, which is fine. Okay, so handout for today. And the URL, if you're on a computer online, it should be popping up as you come into class. If you're not on a computer, Haley has put in the URL, or will put the URL in the chat window again, and it's on the screen if you're watching later. It's http://tiny.cc/ch11small. Okay, that's just a list of the questions that we're using today, just to save you some writing. Okay, so Chapter 11, and this is one of the reasons we can do a chapter in a day, because we're not doing the whole thing. When we get down to these last chapters, there's a lot of things that are very interesting from an accounting standpoint, but they really go beyond the scope of what we want to do. So Chapter 11 is an excellent example. Chapter 11, there's 6 learning objectives in the chapter. We're only doing learning objectives 1, 4, and 6. In study plan, you will only see these learning objectives. You will only see these learning objectives on the exam, and that's what we're doing. So that's we're going to be focusing today. Today we're not going to do so much on quality of earnings. That's in the video lecture. We are going to focus more today on learning objectives 4 and 6. So we're kind of doing the intro to the topic today, and then the video lecture picks up where we leave off. Okay, so that said, we're going to start with earnings per share. Earnings per share is one of the most frequently quoted numbers in the popular press. If you go to open up any report about a company, an article about a company, a lot of times they'll say the company's earnings per share was what. And earnings per share, intuitively what you're doing, just thinking about from an overview, is you're taking all the earnings you had and dividing by the number of shares. So that's really easy. That's conceptually what it is, and conceptually it's really easy to think about what that is. Now when we actually go to calculate it, we have to take a couple things into account. First of all, this is something divided by something else. So the top of this equation is going to be our net income. So those are the earnings, our net income, and then we're going to subtract our preferred dividends. When we're talking about earnings per share, it's earnings per share of common stock. So what we're trying to do is we're trying to calculate what earnings were available to the common shareholder. So we're going to take our net income and subtract out any preferred dividends we paid. That's the numerator. Okay, numerator, and then what we're going to do is we're going to divide by our number of common shares outstanding. Okay, some notes here. Average number of common shares outstanding. In some problems, most problems, you'll just have common shares outstanding and you'll use it. But that the word average in front of it, if you're given beginning of year and end of year, you have to take the average of those. So in real life, when we're calculating our common shares outstanding, we don't take the number from the end of the year. We take the beginning of the year plus the end of the year divided by 2. So that's what average means. Most of the time in here, I think we can just use the number. It tells us the average shares outstanding. Okay, so that's the formula. There's very few formulas in this chapter, but that's one of them, and you do need to be able to calculate earnings per share. So what we're going to do now, this is earnings per share, this very often reported earnings per share number. And what we're going to do is we're going to do exercise 1120A, which is on the homework. And this is actually calculating earnings per share. So we're going to get the opportunity to apply that formula that we just talked about. Okay, so exercise 11-20A, we're given some information off their balance sheet. So we're given the preferred stock information, we're given common stock information, we're given treasury stock information. Now let's review what we know about that. First of all, preferred stock. When we calculate a preferred stock dividends are the par value times the percentage. That's how we calculate a preferred stock dividend. So we're given the par value, the percentage, and how many shares were issued. Common stock, we're given the par value, the number of shares issued, and the equity value. And then below that, treasury stock, common. So that's just telling us we bought our own stock back. It's called treasury stock, and 120,000 shares at cost. What kind of account is treasury stock? Contra equity, you're right. Okay. Contra equity? Because do we add or subtract it to equity? Subtract it, yes. Remember we talked about this on Monday. Treasury stock is our own stock we've bought back. So treasury stock is a reduction of our equity. So that's something to note. In this list, it's not giving us the part of the balance sheet, it's just giving us numbers from it. So you have to realize that when you see treasury stock, that's going to be a reduction. Okay, now during 2012, the company earned net income of $6,200,000 and compute their earnings per common share for 2012, round it to 2 decimal places. Okay, so we're going to work through this homework problem. Okay, so what I've got there is the formula we just had on the prior page. Okay, so this is what we just said, that our earnings per share is net income minus preferred dividends divided by the average number of common shares outstanding. Okay, so first thing, so we're just going to fill in numbers. The first thing, our net income, $6,200,000. Now, our preferred dividends are going to be the par value of the preferred stock, the $20, times the 2% rate, times 11,000 shares issued. Okay, so the $20 par value times 2% times 11,000 shares issued. Okay, so that gives us $4,400. Okay, so there's our preferred dividend. So we're going to subtract that. So our numerator is going to be the $6,200,000 minus $4,400. That's our numerator. So now we need the average number of common shares outstanding. Now it just tells us we don't have to do beginning of the year plus end of the year divided by 2 because they're not giving us beginning and ending of year. Now the common thing to do here, or the most frequent thing I would see people do here, is grab that 1,100,000. However, that's not our common shares outstanding. That's how many common shares we've issued. Okay? What we have to do here is we have to subtract the treasury stock, because if we buy it back, it's no longer part of our common shares outstanding. So what we're going to do here, we're going to take those common shares of 1,100,000, subtract the treasury shares that we bought back, so we actually have 980,000 shares outstanding. So that 980,000 is our denominator, goes on the bottom. So now we can calculate our earnings per share. Okay, earnings per share then is going to be $6.32. That is rounded. So that's taking the 6,200,000, subtracting the 4,400, taking that number, dividing by 980,000. I'd say this is a very good example of calculating earnings per share, because you have to do a couple things. You have to worry about the treasury stock. The treasury stock, it's really easy to forget that that's there. You may have it, you might not have it, just depends. Okay, so let's start doing questions. So these are on your handout. Okay, and this one, I want you to work out. Okay, it tells us that we had net income for the current year of $700,000, 5,000 shares of $100 par value 10% preferred stock, and 40,000 shares of $1 par value common stock outstanding for the entire year. Earnings per share was what? So if you're online, click in. Okay. If you're in here, I'll be around looking at answers over people's shoulders. So we're gonna wait. I'm gonna give you a minute or two to work on that, and then I'll be back around. Okay, yeah, I'm still talking. I'm looking around. What do you have? Okay, okay. Wasn't too bad, right? No. I'll be back. Or did you? Okay, you know you have all the questions on Handout? Did you miss it? It's right up there in the middle. Yeah, that'll save you a lot of writing. Okay. Okay, I'll be back. Yeah. I have a different answer. Why is that? Look at this part. Okay. Better, right? Yeah. Hello, how's this one? I'm not. That's a surprise. Yeah. So you need to work on it. I want every single person to have the answer before I put it up. Okay? So, yep. Oh, don't worry. Don't worry. Don't worry. You'll see. I know that. Yeah. Okay. So what's the next number? Okay. So your next number is going to be this. How do you calculate those? Preferred dividends are going to be what? Your par value times your percentage times the number of shares of preferred stock. Right? So with the preferred stock, how many shares they had? They had 5,000 shares. Par value times the percentage. It's just all three numbers together. So then you're well on your way. Okay. Well, why don't you write down the formula? Okay. We're going back to the formula here. that formula? Okay. Okay. What about you? Oh, good. It's on your calculator. Yep. Okay. Probably write down the formula and then fill in numbers like I have up here. You're still working? Okay. Yeah. Yep. Did you say, let me see. Yeah, good. I walked by and then I was like, wait a minute, that didn't quite register. I'm looking for a number. I don't. Okay. Yeah. Okay. Okay. You have it. I don't. I know the number. I don't know. You get it? Yeah. Okay. 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 What about you? Where are you in? Oh, I'm rotating around. Okay. And I was here, right? Okay. Let me see where. I don't know that I made it all the way over here, did I? Did I make it to you? Do you have it? Where is it? It's not right. Okay, so let's figure it out here. Okay, so your first number is your net income. Then the next number, the dividend is, okay, and then use this number so that you don't subtract preferred shares. For that denominator, just take that number. You don't need to calculate that. Okay? I was here, I saw you. Okay. Good. Haley, how many answers do you have? Okay. Out of, subtract 4. 18 out of 55? Wow. Okay. Okay, you're good. Okay. It's average. So how many common shares do you have? 45,000? Where's the 45?
40. Whatever.
Don't you have, doesn't say 40? Mm-hmm. There you go. I'm back. Okay. So here before. You got it? Okay. See, wasn't that fun? Okay, so we saw everyone had, you can't see the question anymore because I took it down. Because it's on the handout, Georgie. There's the question. Okay, so when we're doing this, what we're doing, and I know everyone in front of me has the answer because I just went through and verified it. So what you're doing on this is you're taking that net income minus the preferred dividend. Our net income is $700,000. The preferred dividend is always going to be your number of shares times the par value times the percentage. Divide all that by the number of common shares outstanding, average common shares outstanding. And this one, the common shares outstanding, they don't give you a beginning and end, so you can just take the common shares outstanding. So you would divide by the 40,000 shares. You don't need to note that you do not, and a couple people I saw, they took the common shares and subtracted the preferred shares. You don't do that. The denominator is common shares only. When we're talking about earnings per share in this class, we're talking about earnings per common share. Okay, so now let's go on. I think we have the next one. Okay. So just to verify, 1625. Okay. Okay, so on the next one down, again, I'm not going to do the calculation. So you're responsible. This one's not bad. You need to calculate the amount of income to be used in the calculation of earnings per share. So this question is asking you for the numerator. That's all you have to do. So it's less work than the one we just did. So calculate the income to be used in the basic calculations of earnings per share. That formula, Haley will type it in the window, is net income minus preferred dividends. And my audio is on, yes. I'm looking over shoulder. Okay, yeah. I didn't memorize the number, but I'm seeing it over and over, so I'm just skipping. Yep. I'm reading upside down, then I'm like, wait a minute, I should look. Okay. Are you good on this one? Yes, you are. Good. Okay. So that numerator is not bad to look at, to calculate. Okay, so that numerator, how you're calculating it here is indeed the C352,500. That's the 420,000 minus your preferred dividends. That's all this one's asking for. Okay, next one. Okay, when calculating earnings per share, preferred dividends are, what are we going to do to preferred dividends? We're going to add to net income in the numerator, add it to common shares in the denominator, subtract it from common shares, or subtract it from net income. So think about what we're doing when we're calculating earnings per share, which we just did that formula. What are we doing with preferred dividends? What do you have? Yeah. Okay, so what we've got here then, D, subtracted from net income. So that's off that formula we just did. As you can tell, that formula for earnings per share absolutely should be on your reference sheet for the exam. You're going to see questions referring to it that you can use it to answer questions like this one. Okay, in this one, I put in slide 4 in your handout is a duplicate of the one we just did earlier. So we are skipping it, unless you want to do it again, which is fine. But okay, so now on to management's responsibility. Now we're on to that 4th learning objective, and that 4th learning objective, or the 6th learning objective, I'm sorry. We kind of are leaving earnings per share for the moment, and now we're looking at management's responsibility for financial statements versus auditors' responsibilities. So when we have financial statements, bottom line, management's responsible. As management, you cannot say our auditors prepared it. Or our auditor said it's okay, we don't understand it, they say it's okay, and try to push the blame off. That is a direct, this management's responsibility. It always has been understood that it's management's responsibility, but it wasn't law until Enron happened. And when Enron happened, what Enron did, among other things, is Enron made up their own accounting system. They did whatever they wanted to do, and they made up numbers, they made up net income, and then their financial statements were obviously bogus and not right. So when the government prosecuted the chief financial officer and the chief executive officer of Enron, their defense was, we don't know, the auditors understood it, we didn't understand it, how are we supposed to understand financial statements? So the reaction to that was Sarbanes-Oxley Act, which has lots and lots of requirements in it, but it spells out and says management is responsible for the financial statements, period. They're also responsible for internal control. Internal control, if we remember, are those things that are in place that help safeguard our assets. So internal control are things like we're locking the door so people can't come in after hours to steal things. We separate duties so the same person isn't paying bills and ordering merchandise. Okay, so management's responsibility, they issue a report on how strong internal control is. They say we're responsible for financial reporting, and management's responsibility is also in this report with their financial statements. It states that it's conducted an assessment of the internal controls, and those internal controls are effective and audited by outside auditors. So now let's go on to outside auditors. So management's the CEO, the CFO, all those people in the company that are running the company, employed by the company, that's its management. Management's responsible for that. Now, on the other hand, we have auditors. And auditors come in, they are hired by the company, they are not employees of the company. They're certified public accountants who are independent, and they come in and they check things. And they're doing tests to see if the statements comply with generally accepted accounting principles, if the internal control system is strong or not. So CPAs, these audit firms, come in and test things and give an opinion as to whether these statements are fair representation of what's going on. An auditor cannot guarantee that the statements are correct. The auditors can give a probable opinion. So auditors are independent of the firm, meaning they don't own any stock in the firm. They don't have significant relationships with the firm. There's all these things for independence because the auditors are our best friends. As an investor, I want to know an auditor has been in there, an independent party, looking at what's going on in that book, so I have some confidence that the company is reporting accurately. It is not a guarantee, but it is certainly more assurance than we would have otherwise. Companies, publicly held companies, are required to have an audit, and the SEC has done this so that as investors we have some reasonable assurance that those numbers being reported are realistic. Okay, so the auditor will issue a report on the financial statements and its system of internal controls. The whole investing system would collapse if we didn't have audits, because otherwise if you didn't have audits, you would be, as an investor, relying on the company to say, oh, everything's fine. And in what way would you have to judge that? You don't. So that's why we have auditors. Okay, so what we're going to do now is exercise 1114. And this is a good example of management's report and the audit's report. Okay, so short exercise 1114. What we have here, and if you have the book, I have it on two different slides. So what we have here is we have an excerpt, that box surrounded by yellow here, is an excerpt of management's annual report on internal control. So this is what management includes with their financial statements. So it tells us companies' management's responsible for establishing and maintaining adequate control over financial reporting. So management is saying we're responsible for internal control, And they're also implying they're also responsible for financial reporting. Management evaluated internal control. Based on this evaluation, they've concluded company's internal control is effective. Okay, so that's part of the report they're issuing. And we're given these 7 questions, which we'll come back to. Also in this problem that I couldn't display on the slide is this report. And this is also in the financial statements, and this is the auditor's report. So the auditor's report is very much boilerplate language. They don't just randomly come up with what's in here. This is very structured in terms of what it says. First of all, the audit report is addressed to the board of directors and the shareholders, and it tells what they've done. They've audited the balance sheets, and as of the date, the statements of operation. By the way, statement of operation is an income statement. It's another name. We had that at the very beginning of class, back in the beginning of the semester. Statement of operation is another name for income statement. Okay, stockholders' equity, statement of cash flows, and it tells us the auditors are saying these consolidated financial statements are responsibility of company's management, and the auditors, their responsibility is to express an opinion, and it tells us how they conducted their audits, and then it tells us their opinion. Okay, so this is the audit report. So this is what's attached to every financial statement that a company will issue. Their annual report has an audit report from the auditors. So in this problem, we had the excerpt from management's report, which goes with the financial statement, and then we have the audit report that goes with the financial statement. So we have management making a report, management saying it's our responsibility, and then we have the auditors saying we've conducted these tests, this review of this, and we've reviewed everything, we've audited it. And so that's what we have to work with. So in our homework problem here, okay, so now we're going back to the homework problem. So the first question is, who is responsible for Westminster's financial statements? Now we should be able to answer this just off the top of our head. Who's responsible for financial statements? Yes, management, company's management. And if we wanted to, okay, in the audit report, in that second one, you see circled these consolidated financial statements are the responsibility of company management. So our auditors are saying it's the responsibility of company management. That's law. Okay, we don't need this excerpt to know the answer to that, but management is responsible for financial statements. Okay, next question. By what accounting standards are the financial statements prepared? Now, we can have some choices about what standards they're prepared. The top 2 choices are generally accepted accounting principles, or GAAP, or IFRS, which is International Financial Reporting Standards. So when we want to know how they're prepared, we would look at any audit report. See that last sentence? In conformity with accounting principles generally accepted in the United States of America. So accounting principles generally accepted is just generally accepted accounting principles rearranged. Okay, so that's GAAP. The answer is generally accepted accounting principles. Okay, now this one, identify one concrete action that management takes to fulfill its responsibility for the reliability of the company's financial position. I'm not sure I love this question, but to get the answer, you're going to look up there in the management annual report, and it says company's management is responsible for, and the answer here, I've got it highlighted, is establishing and maintaining adequate control over financial reporting. Okay, so that answer will work for your homework. That's what they're looking for there. Again, I'm not so excited about that particular question, but the rest of these are good. Okay, next question down. Which entity gave an outside independent opinion on the Westminster financial statements? Where was this entity located, and when did it release its opinion to the public? Okay, so for those answers, we're going to look in the audit report, which was given, and look down at the bottom of the audit report. So if you look at the bottom of the audit report to the right where it says SLMA, that's the name of the accounting firm. Okay. I assume this is a made-up one for this homework problem. Well, one of the top 4 accounting firms in the world is KPMG. So I assume they're just abbreviating SLMA to be like KPMG. And LLP, Limited Liability Partnership. Okay, so that's the name of the firm, SLMA. Where was this entity? Let's look back at the question. Maybe not. It doesn't want to go backward. Oh, there we go. Okay. So the question here is, so wanted to know which entity gave an opinion, where was it located, and when did it release its opinion? So looking at that audit report, okay, it's located in Aurora, Colorado. The audit firm is located in Aurora, Colorado. And the date of the report is December 28, 2012. Okay, so for that question, we can answer everything based on the bottom of the audit report. That's where you're going to see the name of the firm, the date, and where the firm's located, or the headquarters for the office that did the audit. Okay. Now, question 5 says exactly what did the audit cover? Well, it's asking about the audit, then we're going to have to go to the audit report. So that's where we go back to that other excerpt that's given in the problem. Okay? So it tells us in the very first paragraph, and this is true of every audit report. First paragraph, we have audited the balance sheets as of September 30th, 2012 and September 30th, 2011, so 2 years of balance sheets and related statements of operations, stockholders' equity, and cash flows for each of the years in the 3-year period ending September 30th, 2012. So it's covering 2 years of balance sheets, 3 years of statements of operations, shareholders' equity, and cash flows. So in the audit report, that first paragraph is going to tell us. There's a word in there called consolidated. It's up towards the top. What that means, this is just an aside, it's not being asked for in this problem, but consolidated means that they have taken all the subsidiaries they have and they have added them together. So we're not going to have, if this particular company has a couple subsidiaries, all their subsidiaries get added in. So they have one balance sheet because investors don't want to take 5 different balance sheets or 100 different balance sheets and add them up, and then it gets really confusing. So we have one balance sheet, and that's called a consolidated balance sheet because we've taken all the subsidiaries together. Okay, so that would be the answer for what was audited and what were the dates. Okay, by what standards did the auditor conduct the audit? So again, we're going back to the audit report. And that second paragraph, we conducted our audits in accordance with the standards of the Public Company Accounting Oversight Board, PCAOB. That came from Enron. That came from Sarbanes-Oxley Act. That created the Public Company Accounting Oversight Board. So PCAOB is where their audit standards that they used. Okay. And then that last question, what was the auditor's opinion of the financial statements? So auditor's opinion of the financial statements is going to come in that last paragraph, and it says, in our opinion, and this is very much dictated language. You're going to look at audit reports and they're all going to have the same language. The consolidated financial statements referred to above present fairly in all material respects. Those words, present fairly in all material respects, are what the opinion is. And this is a clean opinion, meaning that they didn't find anything. So they would think the strongest language you're going to get is present fairly. You don't get language about we guarantee the financial statements or the statements absolutely represent. They'll say present fairly, this is an opinion. As an investor, you have to know that having an audit report is not a guarantee that everything's right. It's their opinion based on their testing. They've done everything in accordance with standards, and their best opinion is that this presents fairly. That doesn't guarantee that there's not a problem. Enron had auditors. So there certainly can be problems when we have auditors, but not as many. Okay, so that's exercise 1114, and that was a really good introduction to management's responsibility and audit responsibility. Okay, so now some true-false questions. These are kind of interesting. Publicly traded companies have the option to produce audited financial statements. True or false? Do you have an answer?
False.
Okay. Why?
They don't need option, do they?
Yeah, exactly. Okay, this one just got the answer, said false. It is false, and the reason it's false is they do not have the option. They are required to produce audited financial statements. Okay? They are required to have an audit. That is not an option. Okay, so next one. Publicly traded companies have to file their financial statements with the IRS. I'm going to walk around and get opinions on this one because this one's usually interesting. Oh, I can't see the chat window. Okay. Starting here, what do you think? True? Okay. True? Okay. You're going with false? Okay. False? True? True? Okay. False? Okay. True? Okay. Candace? False? Okay. True? True? Tell them I'm missing him. Okay. What do you think? False? Okay. True? Okay. False? True? Okay. What do you think? False? True? What do you think? True? True? False? Okay. True? False? True? False. Okay. You said false, right? Okay. What do you have? 13 trues and 3 falses. And I think in the room we had a more even split. I was hearing kind of 50-50. And you said false, so I'm going to pick on you, which is a good thing. This is good. See what happens when you walk in later, then I see you. Yeah. No, this is good. This is false. Why did you say false?
Why did I say false? I don't know. I think it kind of got me. Traded, like publicly traded.
Okay.
So I'm thinking out.
Okay. Well, I will tell you have the right answer. We'll talk about the reason why, but you are absolutely right. So you were right. See, it was a good thing. Okay. So this is false. Okay. So let's talk about why it's false. Okay, when we issue a financial statement, so we're a company, I'm a company, so I'm issuing a financial statement. I prepare those financial statements in accordance with generally accepted accounting principles. Because so when I issue my financial statements to the public, I'm using generally accepted accounting principles to prepare them. My taxes are not prepared based on generally accepted accounting principles. My taxes are prepared based on the IRS code, which is very different. The IRS code is not generally accepted accounting principles. We have legislators who have no accounting background creating tax code, okay? So tax code is solely there as a revenue grab. Tax code is not there to inform investors. It's not there for the public information. The tax code is there to get revenue for the government. That's why the tax code exists. So generally accepted accounting principles and the tax code are completely different from each other. The IRS doesn't care what you file for generally accepted accounting principles for the most part. Every company is going to file a tax return with the IRS. So that's what makes this false. You do not file your financial statements. Financial statements, those are published, you get the audit report on them. Publicly traded companies file their tax returns. A tax return is not a financial statement. There's financial statement information on it, but it is not a financial statement. If you are a small business, it is possible, and we're talking a very small business, it is possible that a bank could say, oh, you want a loan? Bring us your tax return. We'll use that as your financial statement. The key here is this is publicly traded companies. Publicly trading companies have audited financial statements that are prepared in accordance with generally accepted accounting principles. So companies file their tax returns with the IRS, not their financial statements. Okay? Okay, everyone should know this. We just did it. An audit report is addressed to the board of directors and stockholders of the company. True or false? A lot of these. Okay, and I just got an answer true. I think that's pretty, you're getting a lot of truth. Okay. And this is true. An audit report is addressed to the board of directors and the stockholders of the company. Okay, it is not the independent auditor's responsibility to determine whether the company's financial statements comply with generally accepted accounting principles. Is that true or false? So this is saying it's not the independent auditor's responsibility. Is the independent auditor checking to make sure the company's financial statements comply with GAAP? Yes, this is worded really backwards, but yes, the answer is false. It is the auditor's responsibility, okay? So that one you just need to watch the wording of. A false is going to make it is the independent auditor's responsibility to determine whether the company's financial statements comply with GAAP. This is like the finale in fireworks. I'm just going to do question after question here. Okay, the audit report is signed off by the corporation's management, confirming the audit was completed properly. True or false? I think I'm going to go. So what do you think? False? Okay. Do you know why, or is that a feeling? It's a guess. Okay. Fair enough. What about you? You know I'm coming here.
Oh, no, I'm
okay. 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 You say false? Okay. Do you have a reason? Okay, because you feel like it's the audit's report's responsibility. The auditors. Yeah. Yeah, you're getting a thumbs up so that, yeah, you think that same thing too? Yeah, it's false? Yeah. So you're all right. Yes, that this is false. Good reasoning. The audit report is not, the auditors are not evaluated by management. The auditors are there to evaluate internal control, to evaluate how the financial statements are. Management doesn't come along and say, oh, let's see how you did your audit. And because then we could have all kinds of games being played here, because then management could say, we don't like your audit opinion, so we're going to say that you didn't conduct it right. You know, so no, the auditors are independent. Management does not evaluate them. Okay. Next one. Now this one is interesting. An unqualified opinion by independent auditors. You would have had to read this, I think, to get this question. An unqualified opinion by independent auditors indicates the fairness of the company's financial statements and effectiveness of its internal controls. I'm not even going to pick on anyone on this one because it is so misleading. So you say, whoa, who wants an unqualified opinion, right? No one wants an unqualified opinion. Well, actually, you want an unqualified opinion. This is actually true. Okay, and let me explain why. And it has to do with the meaning of the word unqualified in the audit world. You know that when you're talking, you can say, I like something, but let me qualify that by saying, okay, so I could say, this is a stupid example just because I can't think of anything else off the top of my head. So let's say, I'm going to say, I like fruit cake. Thinking of Christmas here. So I like fruit cake, but let me qualify that statement by saying I don't like nuts in it. Okay? So what I'm doing there is I'm qualifying my statement to say except for. Okay? So a qualified opinion says everything's okay except for this thing. Okay? You don't want a qualified opinion. Qualified does not mean I have a level of competency. Qualified in this instance, when we talk about audit reports, qualified means exceptions. So an unqualified opinion means there's no exceptions, which is what you want. So you want an unqualified opinion. And now I have a question for Haley. You know that this unqualified opinion term is going away. Have you learned that? Okay. Okay, so this is advance notice for those of you who are accounting majors. For the last, I'd say, 40, 50 years, we've been teaching about unqualified opinions as being what you want, okay? Well, in the latest revisions to audit standards, they have done away with the term unqualified opinion. It's now called a clean opinion, which makes 1,000 times more sense, doesn't it? But you still have to know unqualified. So, and you probably do too. But for the CPA exam, when you take it, Haley, you will have the new set of standards. But you probably have to still know both worlds. But yeah, so unqualified opinion, I believe the new term is clean opinion, which makes so much more sense. So unqualified opinion, do know that that's what you want. You want unqualified because there's no exceptions. Okay. Okay, which entity requires companies issuing publicly traded stock to have their financial statements audited? So who's the entity saying you have to do this? Okay. These are all real things, by the way. Even C is a real thing. It's called COSO. What do you think, Melissa? Okay, that's one thought. Okay. 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 And this one, it's really unfair to ask you because unless you've read the chapter ahead, which I certainly didn't require that, this would be challenging to know. So you said A. I'm going back here. Okay, did you know that? You're right, but that was a good guess or good thought? Yeah, okay. Okay, so the answer here is it is indeed the Securities Exchange Commission, the SEC. The SEC governs public trading. Okay, they're the ones that are in charge of public trading, so they're saying if you're going to be publicly traded, here's the requirements, and one of the requirements is to have financial statements audited by an external auditor. Financial Accounting Standards Board, that's a good answer. That's how we have, that's who creates a lot of the guidance for how the statement should be prepared, but they don't have the weight of law. FASB does not. The SEC is law. Okay. Okay, now there's another little bit of the chapter called retained earnings correction. So it's something to talk about. Retained earnings. Retained earnings we talked about before, and retained earnings is this running total of all our income to date, less any losses, less dividends. So maybe you want to write that in the chat window. Retained earnings equals cumulative income minus cumulative losses minus dividends, or however you want to phrase it. Dividends. Haley's typing it in the chat window. Retained earnings equals cumulative income. So cumulative income, when I'm using the word cumulative, it's just saying all our income from the beginning of time to now. And then less all our losses from the beginning of time till now. Less dividends. And those are also cumulative, but we don't need, I mean, it's just all the dividends we've paid. Okay, so retained earnings is like this running total as a score. You know, how have we done? You know, now when we make mistakes, because mistakes will happen, those are called, in many cases, to correct them, we call them prior period adjustments. Let's say we're this year and we discover a major mistake from last year. Well, rather than mess up this year's financial statements, we do something called a prior period adjustment. And this is when we find that revenue or expense was recorded incorrectly in an earlier period, and we adjust the beginning balance of retained earnings. Okay, so given that, which we just said, a prior period adjustment that corrects income of a prior period requires an entry to what? Okay. What do you think? C, retained earnings. Yes, you are right. Okay, so prior period adjustments, you can link that with retained earnings. Okay, so these prior period adjustments, we said they go into retained earnings. Do they decrease retained earnings, increase retained earnings? Can do either one or don't affect retained earnings. Okay. And the answer here is, depending on what the error was, it can either increase or decrease retained earnings. There's no standard error. Because we can make errors in our favor, we can make errors not in our favor. Okay. So what's due this week? As a reminder, don't go away. Okay. And you're going to get credit for coming again today. So if you're online, I need you to type your name in the chat window, first and last name. As soon as you've typed your name, first and last name, I need this attendance sheet. Do not stop recording yet, but when you've typed your name and you can see it in the chat window, you're good to go. If you're in class, you need to sign one of the green sheets. Okay, let me start here. Once you guys sign that. Please don't leave if you're in class until I get the green sheets back. Okay, so if you just wait a minute, it won't take long. only sign one green sheet. I've got several of them. Okay, you'll find his. And again, just sit with the green sheet once it comes to you and there's nowhere else for it to go. Okay.
Oh, you got it.
Oh, you got it? How far did it go? Okay. Did you get it? You got one right behind you. Okay, so let me see where, okay, so let me just run through this. So don't wait till I get the sheet that has your name in it. So we have Phil, Nathan, Alyssa, Blake. Good, you guys are good. Where's your sheet? Okay, just a second here. Okay, look and see what's on your sheet. Okay. Okay, so Candace, did you get to sign? Oh, there you are. Okay, so you guys can go. Hey, will you pick up sheets and you're verifying names? Okay, so don't leave until Haley gets your sheet and it's visually found you. So check names. Start with the. Okay, just a minute. Okay, where's the next screen sheet? Okay, so there should be 4 names on here. 5. Who's? Okay, great. Thank you. Just a second. If you're watching this online, you can stop. Okay, where's the green sheet? I've got you 2. Okay. Where's? Okay. Okay, will you stop recording then? Thank you. And save that chat window. Go ahead. Can you come see me?
Yeah.
Okay.